All right, I have the SPY daily chart on here. We're going to start off with technical analysis. And the reason why you should do your market analysis on SPY is because it's the S&P 500, the market index. Whatever trend it is in, most of the stocks will follow. So this helps you set your bias on your investments and your trades. So first, I always like to look at one of my favorite indicators, AVWAP Q, which is this white line you see on the screen. This is the VWAP, volume weighted average price, anchored to the beginning of each quarter. This has been a very reliable indicator to let you know whether buyers or sellers are in control. It's very easy to read. When price is trading below AVWAP Q, that means sellers are in control, and that makes me bearish in the short term. When price closes above AVWAP Q, that means buyers are in control, and it makes me bullish in the short term. So with our historic trading day on April 9th, with the market closing about 10% higher that day, in one day, that day switched me from a bearish short-term bias to a bullish one. And a big reason for that is because price was able to close a VWAP Q. And since that day, it's been able to hold it. It was tested the next day with this long wick on the bottom, which recovered. The following day, another test. We bounced off a little bit, came back down, retested it, and I've been holding it for a full week. The longer it holds, the more comfortable buyers are to support this market move to the upside. But keep an eye on it because, we're still well below the 200-day moving average. So my personal bias for the short term right now is neutral bullish, and for the long term, it is neutral. In my last video, I kind of showed you why I think the market may have bottomed here. At this point in time, I'm about 75% that I think the market bottomed and 25% that I think there's more downside. If you want to know the reasons why, please look at my last video. I go over those indicators that I saw. And this week, actually, I saw a new study that using the VIX and using the VIX to determine whether the market has bottomed or not, which I'll go over just in a bit in this video. But I'll go ahead and take a look at the moving averages because simple moving averages are very, very important to help you determine trend. Now, the first thing is that a lot of people have been talking about the dreaded death cross, right? That's the 50-day moving average closing below the 250-day moving, the 200-day moving average. The 50 days in blue, the 200s in purple or pink. And we, I guess, formed the death cross on Monday, April 14th. So the death cross had the reputation of meaning that, we're going to see a recession or a bear market, we're going to see lower lows, more pain is coming basically. There's more pain. So I went ahead and I looked at the S&P 500 from 1960 until present time and looked at all the death crosses that I saw. And I wanted to share with you the results. Basically, there were a total of 28 death crosses, not including the one that we just saw now, from 1960 till 2025. And out of those 28, 11 of those resulted in more pain. The years were 2022, 2008, 2000, 1984, 1981, 1977, 1973, 1971, 1969, 1966, and 1962. The other 17 times that it showed up, it was actually at or near the market bottom. So based off the study, the chances of more pain after a death cross is only 39%. So market is about odds. There's no guarantees, but you try to invest and trade and make decisions with the odds in your favor. And of course, past performance doesn't not indicative of future results and all that stuff, but human behavior is human behavior, and the stock market is run by human behavior. It's participants buying and selling shares of a company. Think of the stock market as a sentiment indicator, if you will. So to me, there's a 61% chance that the market is at or near the bottom, and a 39% chance it could go lower. So, using that, I say I have invested more cash in the last 2 weeks. I have not fully invested all my cash because I'm not using it. It's important to be open-minded, right? And that you could be wrong and that there could be more downside. If worst case scenario, if we, I don't know, it's not the worst case, but let's just say we did actually bottom and I have, let's just say 15% of my cash reserves left, I'll deploy that and I'll dollar cost average up. Very simple. But what I don't want to have, what position I don't want to be in is be fully invested and then the market keeps going down and I have no more cash left to invest. So that's how I'm handling this current situation with this death cross. Now, the actual way to determine long-term market trend is using the 50-day moving average and the 150-day moving average. This one, a bit more, this is more accurate, certainly, about a 70% plus accuracy rate with this indicator. So the way it goes is that it's not about just the cross down, the 50-day cross below the 150-day on April 4th. It's actually about the direction of the slope. We want to see the 50-day slope down more than 10 degrees and the 150-day slope down more than 10 degrees at the same time. That is what triggers the indication of a longer term downtrend. As it stands right now, the 50-day is sloping more than 10 degrees down, but the 150-day is not. Therefore, I still don't think we are in a long-term downtrend just yet, but we are really close to it. Like if the market has bottomed now, we should expect a recovery of the 200-day and the 50-day within the next month, like a few weeks to a month. If we don't get that, then the 150-day will start sloping down 10 degrees and that will confirm a longer term bear market. Since price has slashed below the 200-day moving average like we see here, I started plotting my downside targets based on percentage points. So 10% from the all-time highs, 15 and 20%, which I'll show here. And we have hit each of those. And as an investor, I made sure to set aside my cash reserves in chunks so I can invest each chunk at each of these targets. So I have invested a total of 4 times during this drop so far, and I still have enough cash reserves for another investment. And I want to show you what my downside target if this ends up not being the market bottom. On average, all bear markets have averaged a drop of 35%, and the bear market bottom has come in around 250 days from the all-time highs to the bottom. That would mean that one of my ultimate downside targets on the S&P 500 or SPY would be 400 by end of October of this year. So that gives us about 6 months. If we break below this 20% drop here, we break below this low right here. I'll zoom in, draw this ray. We break below 480 on SPY, we're most likely going to start seeing a bear market and head down at 35% target. You have 6 months to budget and to increase your savings to invest into the market as we head down. Okay, do not be scared and do not sell for a loss. Like this isn't the time. If you have speculative companies, those ones you should cut, in my opinion. However, if you're holding great companies like index funds, Apple, Amazon, Google, those great companies, this is not the time you want to be selling. This is the time where you should be happy as an investor and say, I'm going to start saving money and I'm going to take advantage of this next 6 months and I'm going to invest into these positions. That way, when the market recovers, I will have a great return. That's, to me, the worst case scenario, which doesn't sound as scary anymore, I hope. My optimistic scenario is that we are going to continue this rally from here. At least I retest the 549 level, ultimately break it, and then retest the 200-day moving average at around 573. That's what I could see at least in the next couple weeks probably in the next couple weeks. Now for some fundamental analysis, which is probably it's going to be pretty light in this video because there have not been really made any major economic news that came out this week or any major news that will come out next week besides earnings season. We are in earnings season, so just when you're taking your trades, just be aware of the earnings date for the tickers that you're trading. You know, you definitely don't want to hold any trades over earnings because now it becomes a gambling position instead of a trade position, and we're not gamblers, we're traders. So on that front, I do for my investors and for myself, I always update my stock valuations for each stock that announces earnings. And I save all of my valuation reports in my Discord server, which is free, and link it will be in the description of this video. And this week we had three companies that I track that reported earnings. It was United Healthcare, Netflix, and Johnson& Johnson. And I'll just briefly go over the updated valuations for these companies. I have United Healthcare at a valuation of 505, which is a drop previously from 525, which makes sense given the guidance cut that they had. I see it as neutral in terms of technical outlook, which means we're not in a bull market, not in a bear market, we're in a sideways market on United Healthcare. And I see it as being undervalued. United Healthcare is the second largest holding in the Dow Jones, right below Goldman Sachs, and it still has a great company. It has great fundamentals. It has a 2 out of 3 fundamentals rating on these three metrics that I track on their balance sheet. It has a high ranking in the S&P 500. If you wanted a healthcare stock that pays a good dividend, that's defensive, and you don't have any and you want to start a position, I think United Healthcare is a good choice to do your own due diligence on and look into. Netflix also reported earnings this week. Now they have a fair valuation of $803 per share, which still keeps it overvalued. However, it's bullish. It's bullish while the market has been down. So keep that in mind. It's a very strong stock. It has a good balance sheet with a 2 out of 3 fundamentals rating, and it's ranked highly as well in the S&P 500 at number 18. However, because it's overvalued, I think there are a lot of other stocks that are undervalued that have even better balance sheets, like Nvidia, like Google, like Amazon, that would be better focused on. But if you own Netflix, good job. They're holding up really well. They're coming out to be a pretty recession-proof stock, it seems like so far. Unless a consumer gets hit really hard, but that hasn't happened yet, which is good. And then the third stock that reported earnings was Johnson & Johnson. So with a fair valuation of $162 per share, they're undervalued and they have a neutral technical outlook, which means they're in a sideways market. Again, they have good fundamentals rating, 2 out of 3, and they're also ranked highly in the S&P 500 at number 21. Johnson & Johnson is another good healthcare stock that is defensive, that pays good dividends. Another good option if you wanted to add a healthcare stock to your portfolio. I track between 30 to 40 stocks in this valuation database, as you can see on the left here. I have tags that show which stocks have a 3 out of 3 fundamentals, which stocks are undervalued, which stocks are fair valued, if they're bullish, neutral, bearish, and I provide this for free. And so if you want more data, you want more information, you want more analysis, definitely check out this Discord. Personally, my portfolio returned about 45% last year, and without any very little speculative stocks. My only speculative stock was Palantir, and besides that, my portfolio was of mega cap stocks like United Healthcare and Costco and Meta and Apple, Microsoft. So this will really help you save time to build your long-term investment portfolio. You won't have to sift through crappy stocks that aren't sure, well, if they will perform or not. The stocks that are in this valuation database have been screened with really strict standards, and that will most likely perform well due to their things like their economic moat, their positive free cash flow growing consistently, their low debt, their high cash position, etc. I'm going to end this video off with this study that I did using the VIX and how it correlates with market bottoms. The VIX is a volatility index and was created in the 90s. So the earliest reading I have for the study is October 1998. And basically what the study does is that on the VIX weekly chart, when price goes above 45 and then closes below 30, that indicates a potential market bottom. And so the rows that are highlighted in blue, like October 2008, March 2020, and August 2024, and April 2025, were the times the VIX was above 60. So since 1998, that's only happened 4 times, while the other times it just was above 45. But you can see here, these were the highest the VIX was in that time period. This column shows how long it took for the VIX to close back below 30, how many days it took. And then this column shows you whether that was a market bottom or not. And then these columns over here show you the percent return from this point in 1 month, 3 months, 6 months, and 1 year. And the way these are measured is, for example, in August 2024, that was a weekly candle of August 5th, 2024. I measured the S&P 500 return from the close of that weekly candle exactly 30 days from that point. That was a 1.2% return. This isn't a measurement from waiting until VIX closes below 30. This is a measurement from the weekly close of that candle on the VIX that hit this high. So as you can see, if I use all the averages, 78% of the time, this showed that it was a market bottom. And the average return 1 year from that point was 21.5%. If I only use the average when the VIX was above 60, which is incomplete because we have one in 2025, which we don't know the results of, we see that there is a 1 year average return of 32%. But to be conservative, let's just say if you invest whatever money that you decide to invest in right now in a wise way, you can expect to see a 20% return a year from now in the S&P 500 index, such as SPY, VOO, or VTI. Let's just say, let's just say this isn't the bottom. This is one of those times where this study did not show a market bottom. What then? Well, in 2008, the market fell another 24% before bottoming in March 2009. That's about 5 months. Even in that instance, after 1 year from that point, you saw a 19% return on your investment. And, investing is it's a marathon, it's not a sprint. So you want to be able to make sure you save money to invest every month, load up on your cash reserves, and inject into the market at strategic times. So if you injected, let's just say, 50% of your cash reserves at this time in October 2008, you have another 50% of cash, saved up. The market keeps heading lower for the next few months. You DCA. So this 1 year return will be much higher. This only assumes you just bought in the week of October 2008 and just held and didn't do anything else. So that's how you want to use these studies. This doesn't mean that, it triggered, I'm going to go all in now. You never do that. These just help you get an idea of what you can expect based on past market performance. And we play by the odds. That's how we invest and that's how we trade profitably. You play with the odds. You want the odds in your favor. And what I'm seeing right now, the odds are showing that we might have seen the market bottom. So I hope this video was helpful for you. I would really appreciate if you liked it and found value. Please give a like. Please subscribe. And if there's something you want to see, please leave a comment below. I'm very new to YouTube. I'm enjoying making these videos. I want to be better at it and I want to give good value. So let me know what else I can do for you. And good luck in the next week.